Are you a real estate investor who's fed up with the hassles and complications of obtaining financing for a real estate investment? I'm Rob Ellis of RE/MAX Realty Partners in Morgan Hill, California. There's a program available called the Debt Service Coverage Ratio Loan, or the DSCR for short, which greatly simplifies and streamlines the entire underwriting process from application to close of escrow. I sat down with Mike Gallagher, Senior Loan Officer at Cross Country Mortgage, to go over the ins and outs of this great program. You're gonna like what you hear, and there's a lot of great information, so check it out. Let's talk about investment property loans. Anyone who has ever gone through the application and qualifying process knows that the sheer quantity of supporting documentation and personal financial records can be tedious and borderline invasive. But what if there was a more streamlined process that weighed less on the investor and more on the performance of the actual asset? I'm here with Mike Gallagher of Cross Country Mortgage. Their new investment loan program, the Debt Service Coverage Ratio Loan, or the DSCR for short, does just that. Before we get started, just keep in mind that all of our contact info will be at the end of the video on screen there for you to jot down if you need to talk to us. Okay, how you doing, Mike?
Doing good. Thanks for having me.
Great. Well, this DSCR I find very interesting. What makes this program so unique?
So, well, typically when an investor or home buyer is applying for a home loan, we're required as lenders to document income for qualifying purposes. That can get, as you mentioned, can be tedious or borderline invasive. Just the sheer amount of documentation that we would normally require can be overwhelming, particularly if someone's got multiple properties on their tax returns, or for whatever reason just doesn't want to turn over tax returns.
So do you need to calculate a debt to income ratio on these loans?
So it's a little different. What we're using, it's not your traditional debt to income using the borrower's income. We're using the income derived from the property. So it more closely resembles what you would typically see with a commercial property loan, where we're using the income from the property as the source of income for the loan.
Got it.
So we're not bothering with W-2s of the borrower, tax returns. None of that stuff is required with this particular loan.
How are the rents actually calculated?
So good question. If the property is vacant, we're going to have an appraisal on the property ultimately, and included in that appraisal will be a market rent survey. And so we'll use that market rent. If there is a tenant in place and it's a purchase, and the intent is to keep that tenant in place, we will use whatever rent is currently being collected from the existing tenant.
Okay, again, just makes sense. Really does.
Yeah, it's a very simple calculation. Rates are very comparable to traditional mortgages. It's just a simplified way to qualify someone based on income.
Okay. Are there any down payment issues?
So
restrictions, I should say.
Yeah. So we will we'll allow as little as a 15% down payment. The bigger the down payment, the less restrictive we are when it comes to the rent. So, for example, if we have at least a 30% down payment, we really are not doing a very strict debt to income calculation on that rent. In other words, for example, say it's a fixer-upper and the current market rent based on the condition of the property is maybe half of what it could be at some point in the future. We're not going to get too hung up on that, even if that net income or that gross income doesn't cover the debt service. Again, but that's with a 30% or more down payment.
Do you need to account for expenses such as property taxes or vacancy rate?
So that is another good question, and that is typical with a commercial property underwrite. We will use net operating income. With this particular program, we're not calculating vacancy or expenses. We're just going off of gross income.
So what if there's a situation where the rents don't cover the full PITI, the principal, interest, taxes, and insurance?
So good question. If again, that comes back to the down payment requirement. So if we're going in with the minimum of 15%, generally we're going to require that gross rent cover the PITI. If we're short on coverage, we can generally allow it with a little larger down payment. So it's kind of a sliding scale. Once we get to a 30% down payment, we really don't care what that rent is and how much of a shortfall there may be.
Okay. So I have several clients who are investors who own multiple rental properties. Are there any restrictions on the number? I know in the past that Freddie and Fannie have had restrictions where you can't own more than 10 actual properties.
That's correct. And this comes up all the time because it's kind of a commonly known guideline with both Fannie and Freddie that they limit the number of loans to 10. And so when we have investors that have multiple properties, that can sometimes be a problem. With this particular program, it's a non-Freddie Fannie program. We have no limit on the number of properties financed.
So there are some investors that would require this program.
If they were already tapped out to begin with,
Mm-hmm.
with the number, and we're working with a couple right now that that have multiple properties out of state. They've tapped out their Fannie Freddie limit of 10, and we're working with them with this particular program. But it aside from the Fannie Freddie, our pricing is going to be very comparable to what you would get with Fannie and Freddie, and without the headache of all the documentation
Mm-hmm.
required.
Okay. Getting back to the actual qualifying, does credit have to be spotless?
Good question. No, because again, we're really relying on the gross rents of the property as the primary factor in qualifying. We will work with really as low as a 620 FICO score. Now, if there's issues that we need to be concerned with, that's kind of another thing. But just a pure FICO score, anything above 620, you're kind of in the game.
Okay.
And if there's some major, if there was a bankruptcy or for foreclosure, depending upon the situation, it's not a deal killer. It really just, may require an explanation, but it is a portfolio program, meaning, we're not selling the loan to any of the agencies. So the underwriting is going to make sense. So
Okay.
if there's a story there behind the credit, we can work with it.
Okay. So I'm assuming that we're talking mainly about 30-year fixed loans, but are there programs within the program such as adjustable rate mortgages, et cetera,
Yes.
or shorter term?
Yeah. And so, and another good question, we can do a 30-year fix, but if we're trying to, for whatever reason, you know, work on the cash flow for the borrower, we do have a 3-year, 5-year, 7-year arm, and we can go interest only on those shorter term deals with no hit to interest rate. So if cash flow is paramount, we may look at doing a shorter term arm, get the rate down off of a 30-year fix, and then going with interest only to really minimize that payment. It works great, particularly if an investor is looking at a value add. They plan on maybe doing some work, increasing the value, maybe refinancing later and pulling cash out. And so that initial loan might be better suited to go with a shorter term arm. There's no prepayment penalty on any of these deals. And so it makes it very flexible as far as being able to get out either with a sale or refinancing at some point in the future.
You mentioned refinancing. Can you use this program to refinance, or is it just for purchases?
You could use this program to refinance as well. The loan to value and the terms are basically identical as a purchase. So if you've got an investor that maybe has a significant amount of equity in an existing rental property, this is a great tool for them to potentially pull cash out for whatever reason, either use that cash out to rehab the property or maybe purchase another investment property.
What's really striking me about this is just the flexibility of this program. It's fantastic.
It is, and it's not entirely new to the industry, but in the past, these programs that have been released typically had a pretty strict debt service coverage where you had to have at least like 1.2 or 1.25 times the existing PITI. So so the lenders really wanted a significant cushion, and oftentimes they would use that income after expenses. So where this program is a little, well, significantly different than what we've seen in the past, is one, we're using gross income as opposed to a net income for calculation, and with enough of a down payment, we're really not getting hung up on how much, if we're covering the debt service at all.
Okay. So with the DSCR, are there any restrictions as far as the way you can take title? Can it be held in an LLC?
It can be
or a
any
TIC?
kind of a, yeah, we can go LLC, any kind of an S corporation, a partnership, any of those entities that individuals would typically use to hold investment properties is all valid.
Okay. And let's talk about using it for somebody who wants to set up a Airbnb, for instance, or a short-term rental.
So that's another good question. So that has, in the past couple of years, it's been tricky to get an investment property financed if it is Airbnb. A typical investment property loan will generally look at rents based on a long-term lease or a one-year lease. So if the intent is to purchase for Airbnb, sometimes you're getting hit on rent because in most cases you're going to get a significantly higher rent amount using Airbnb or some other type of short-term rental. This program will allow a short-term rental. So if the intent is to go Airbnb or some other type of short-term, we're going to use rents based on that strategy.
Okay. Well, I'm excited to get this in front of some of my investors. It just sounds like a really great program. And if anybody is, like I said at the beginning, has gone through the traditional hassles of getting investment real estate financing, they know what we're talking about.
Yeah, for sure. And most of our clients that are purchasing investment property, usually have one or two or more, and so they've been through the headache.
Mm-hmm.
So yeah, this is a welcome relief, and the question always comes up. Well, if we're making it that easy, there must be a catch with rate, and we're really we're doing everything we can in our power to keep that rate as close as possible to what you would typically get with a Fannie Freddie investment property deal.
Yeah, well, it sure, like I said, makes sense. I mean, to weigh heavily on the performance of the asset for investment real estate is just logical.
It is logical.
Yeah.
And it's how the commercial real estate industry has underwritten loans for decades.
And there's a reason for that.
Yeah. It makes sense. They're not relying upon the income from the borrower. They're relying upon the income from the asset.
Got it. Well, like I said, I'm excited about the program and its flexibility. I appreciate all the great information. If you have questions about the real estate market in general, this program, or any aspect of the real estate market, please don't hesitate to reach out to either one of us. As promised, all our contact info will be on the frames at the end of the video. Thank you very much for watching.
Thank you.
Mike Gallagher is a senior loan officer with Cross Country Mortgage. He can be reached at 408-930-6064. Rob Ellis is a realtor with RE/MAX Realty Partners. He can be reached at 408-858-5222.